Okay, picture this. You open your terminal right now, load up a curated universe of 9 highly tracked blue chip stocks, and run a consensus valuation check. The result? Exactly 100% of them are flagging as undervalued, literally every single one. Now, if you're a professional portfolio manager, you know that a signal that uniformly green doesn't usually mean you've stumbled onto a gold mine. Usually, it means the consensus narrative has completely detached from reality. Because when the street says everything is cheap, the smart money starts checking the math.
Welcome to this explainer. Think of today's session as a concise executive briefing. We're going to cut straight through the market noise, taking a universe of 9 major equities, ranging from industrials and tech to healthcare real estate, and we're going to stress test the popular street narrative against cold, hard intrinsic valuation models. If you are managing capital, you absolutely need to know where the margin of safety actually exists and where you're just paying a massive premium for a good story. Okay, let's dive into this. Here is our roadmap. First, the consensus narrative. Second, the intrinsic reality check. Third, valuation multiples. And finally, opportunities and risks.
Section 1. The consensus narrative.
Taking a quick glance at the prevailing winds on Wall Street, notice the absolute sea of green here. Based on the narrative fair value model, which essentially just aggregates popular analyst growth projections, every single stock in this group looks like a total winner. You've got Honeywell supposedly 21.4% undervalued, Eaton right there at 21.2%, all the way down to Deere at 4%. If corporate plans materialize perfectly without a single macroeconomic hiccup, this represents broad upside. But as any seasoned investor following classic Buffett principles knows, a rosy narrative does not produce cash. We really need to look a bit deeper. Section 2, the intrinsic reality check. So when the street is trying to tell us that absolutely everything is cheap, it's time to pivot to the fundamental math. And we do this primarily through the discounted cash flow, or DCF model. Simply put, this strips away all the market sentiment and asks one very simple question. How much cash will this business actually generate in the future, discounted back to today? This is the ultimate stress test. It's the absolute cornerstone of identifying a true economic moat. Because a company with a strong moat generates predictable, durable cash flows. Let's see how our 9 stocks hold up when we demand cash over concepts. And this brilliantly illustrates the danger of buying a story without checking that math. Take Eaton Corporation. The narrative model is screaming buy, with a 21.2% undervaluation. But the DCF model, it flags a glaring, massive overvaluation. Intrinsic fair value based on actual cash flows sits at just $155.37, yet the market is paying over $323 a share right now just for AI data center hype. The market is quite literally pricing in absolute perfection. If you buy Eaton at this level, you have zero margin of safety. Now, let's contrast Eaton directly with Deere and Company. Interestingly, the narrative model actually had Deere as the least exciting play of the bunch, showing only a 4% undervaluation. But look at the DCF reality. Based on projected cash flows, Deere is actually 25.6% undervalued, with a fair intrinsic value sitting around $632. This is exactly what an aligned model looks like. You have a company with a massive, deeply entrenched brand moat in agricultural equipment, presenting a much firmer foundation for intrinsic value than those high-flying tech narrative plays. Section 3, grouping by valuation multiples. Having seen the intrinsic math, the next step is to group these assets by their relative price-to-earnings ratios, just to measure exactly where market enthusiasm is running the hottest. Right here, we are isolating the extreme outliers. On one end of the spectrum, you've got Welltower towering at an astonishing 136.5 times trailing earnings. The market is pricing in astronomical future growth for this healthcare REIT, which, obviously carries massive execution risk. But then look at the other side of the spectrum. You have Union Pacific at a very reasonable 19.8 times, and Qualcomm sitting at an inexpensive 16.8 times earnings. Keep in mind, Union Pacific has a literal geographic duopoly moat, and Qualcomm holds a massive patent licensing moat, yet they are trading at absolute fractions of Welltower's multiple. We also need to flag BlackRock here as another really key discrepancy. The narrative optimism tells us BlackRock is 18% undervalued. However, it's trading at a PE of 27.5 times, which is running incredibly hot compared to its historical fair PE of around 19.5 times. So it's a very mixed signal. Essentially, you're paying a premium multiple for an asset manager right at a time when the entire industry is facing fierce fee compression. Section 4, synthesizing opportunities and risks. All right, it is time to synthesize these multi-model discrepancies into actionable intelligence.
let's rapidly break down the specific threat vectors impacting these equities. Because at the end of the day, a valuation model is only as good as its underlying assumptions. For macro headwinds, we're closely watching the agricultural cycle for Deere and housing market weaknesses for Lowe's. Under execution hurdles, Honeywell is facing immense pressure to perfectly execute its major corporate separation, while BlackRock has to really prove its execution as it expands into private markets. And finally, Qualcomm faces ongoing regulatory pressure regarding its highly profitable licensing model.
Continuing to round out those specific risks, we definitely have to factor in geopolitical realities. Any shifts in global trade or new tariffs will directly hit intermodal volumes for Union Pacific and overseas equipment sales for Deere. For Eaton, that massive valuation premium we looked at earlier, that is highly vulnerable to any slowing in AI data center demand. And for Welltower, with that 136 times multiple, the risk is heavily tied to macro uncertainty and the leverage required to fuel its aggressive acquisitions. So the crucial point is this. When we distill this entire 9-stock universe down, clear lines emerge between actionable conviction plays and highly fragile risk profiles. Your strongest opportunities, the ones combining solid intrinsic value with reasonable multiples, are Deere, which boasts dual-model undervaluation and a wide economic moat, and Qualcomm, which offers a dominant market position at a highly attractive 16.8 times forward earnings. On the flip side, your highest risk profiles are Welltower, weighed down by an extreme price for perfection P/E ratio, and Eaton, which exhibits a massive conflict between its rosy narrative and its underlying discounted cash flows. As a professional allocating capital, the data from this multi-model assessment really forces a hard look in the mirror regarding your current holdings. We've seen today that while the consensus narrative is painting a broadly optimistic picture, the underlying intrinsic math tells a story of extreme divergence. So I'll leave you with this to consider for your own portfolio. In a market aggressively priced for perfection, are you buying the narrative or are you buying the cash flow?